When Bitcoin rallies, if it surges to 500,000 or $1 million, then maybe we could talk about it crashing down by $200,000 a coin. But at the current price levels, it only takes $50 million to turn the entire drive shaft of the crypto economy one turn. And you've got the Trump media organization announcing
Right.
$2.5 billion. You've got GameStop announcing 500 million. You've got my company that's raising billions and billions of dollars. So the writing is on the wall.
Hmm.
Bitcoin's moving higher.
Hi, everyone. Welcome to Smart Invest. Bitcoin is at the heart of one of the most significant changes in modern history that is subtly occurring in the financial system. Both billion-dollar institutions and sovereign nations are now embracing what was once written off as fringe. Michael Saylor is leading this revolution and isn't just sticking to his Bitcoin thesis. He's going all out. During a recent appearance, Saylor not only defended Bitcoin against those who warned of a cryptocurrency crash, but he firmly stated that Bitcoin is mathematically bound to reach approximately $1 million. Saylor believes that a supply shock is unavoidable because there are only 450 new Bitcoins mined every day, and there is a growing institutional demand. MicroStrategy is all in, as evidenced by his mouth-watering 582,000 Bitcoin position. Cathie Wood is increasing the stakes even more in the meantime. In a compelling new interview, she claims that the approximately $1 million goal is just the start. She claims that traditional stores of value are collapsing, money velocity is halting, and the global economy is drowning in debt. For Cathie, Bitcoin is a means of surviving a dysfunctional financial system, not just an investment. This is a macro strategy shift that is happening more quickly than most people realize. It is no longer just conjecture. As we delve deeper into Saylor's strong thesis and Cathie Wood's urgent warning, stay tuned. You can't afford to miss this content, so don't forget to like, subscribe, and enable notifications.
Winter's not coming back. We're past that. We're past that phase. If Bitcoin's not going to zero, it's going to $1 million. And you have all the evidence you need to determine that, right? The President of the United States has determined he supports Bitcoin. The cabinet supports Bitcoin. Scott Bessent supports Bitcoin. Paul Atkins has shown himself to be an enthusiastic believer of Bitcoin and digital assets. Kentez at CFTC feels the same way. The banks are going to custody Bitcoin. Bitcoin has gotten through its riskiest period. The accounting has been corrected. There's now only 450 Bitcoin a day available for sale by natural sellers. That's the miners. At this level, that works out to about $50 million of Bitcoin available for sale every day. If that $50 million is bought, then the price has got to move up to find any seller that's price sensitive. Now, if you do the math, you'll actually see the Bitcoin treasury companies by themselves are buying the entire natural supply.
Yeah.
BlackRock and the ETFs are buying another measure of that. And we've got nation state actors coming into the space. So I think when Bitcoin rallies, if it surges to 500,000 or $1 million, then maybe we could talk about it crashing down by $200,000 a coin. But at the current price levels, it only takes $50 million to turn the entire drive shaft of the crypto economy one turn. And you've got the Trump media organization announcing
Right.
$2.5 billion. You've got GameStop announcing 500 million. You've got my company that's raising billions and billions of dollars. So the writing is on the wall.
Hmm.
Bitcoin's moving higher.
The U.S. economy appears stable on the surface, with small increases here and slight declines there, but a much more precarious picture emerges when you look closer. Fed Chair Jerome Powell is looking elsewhere and concentrating on the two main pillars of the economy: consumption and investment, while GDP headlines only convey one side of the story. In fact, his preferred metric grew by more than 3% in Q1, but that strength is already waning. The cracks are visible in Q2. Businesses are retreating due to growing costs and policy uncertainty. Core investment is cooling, and capital spending is slowing. Customers are obviously exhausted as well. Companies no longer freely raise prices. This isn't because they've given up, but rather because consumers can't handle them any longer. Volumes are declining even in markets that were previously believed to be immune to downturns, such as luxury and household goods. Beneath seemingly stable job reports are concerning patterns, declining revisions, a declining labor force, and uncertain household data. It's a slow bleed rather than a crash. What about monetary policy? It's in a corner. The money supply is hardly expanding, and since money velocity is stagnating, stagnation rather than inflation is now the main threat. This isn't liftoff, but we're also not witnessing a cliff dive. As we release additional interview snippets that analyze the outlook for markets and the economy, stay tuned.
The bill and when it will or will not be passed. We do think it will be passed, and the question is, will it be by July 4th, as President Trump is hoping, or in August as we're hitting up against the debt ceiling? Well, the way Congress works is it responds to pressures much like the debt ceiling. So our bet is on August. And with that clarity, we will have a lot of uncertainty taken off the table. Most importantly, the tax hike that would otherwise occur automatically at the end of the year. And so businesses will probably make more decisions. And in fact, if there's immediate expensing of equipment and structures, then that alone could take the effective corporate tax rate down to 14 or 15%, which is one of the president's goals. Now let's go to monetary policy, and I'll show you some of these charts. But in terms of thinking about Chairman Jay Powell's testimonies recently, he's really focusing on core consumption and core investment, and not looking at trade, inventories, government spending, and some non-core consumption and investment. So, and in the first quarter, while real GDP was negative, 0.2%, this measure of core that Chairman Powell is focused on was up more than 3%. Now, if you take out everything that hit GDP, of course it's going up. Well, in the second quarter, according to GDP Now, it's going to slow down. That metric is going to slow down to 2%. But core investment alone is dropping down 2.2%. Capital spending is getting hit. Again, companies are pulling back until there's more certainty. And so I think that measure will give Chairman Powell pause, especially if inflation remains well behaved despite tariffs. And what we have seen recently is that companies have been taking the hit more to their margins than trying to get pricing through. And why would that be? Well, the consumer is fed up with high prices, and we're seeing a lot of companies report increased prices, but unit growth dropping. And that's in the necessities space as well as in the luxury space. So I think companies are changing their behavior a bit here. And you'll see when we go to the charts, it seems as though the high yield spread is saying the coast is clearing here for a nice recovery when we have more certainty from the tax policy and tariffs, of course. On to economic indicators. Well, employment Friday, something for everyone, as has been the case in most employment reports over these last few years during what we've been calling this rolling recession. This one was no different. You had non-farm payroll employment up 139,000, which looked better than the 125,000 expected. But when taking into account the 95,000 in revisions, that was a disappointing report. And it's also important to remember that nearly 100,000 of those 139,000 were due to the so-called birth-death ratio of businesses, so new business openings, and those get revised. So I think the employment numbers are going to be revised fairly significantly when we look backwards in time. They revise those on that basis, I think, every 5 years. The other thing that we learned is that the diffusion index for employment is right at 50%. So half of the employment categories are increasing and half are decreasing. That's down from 80% increasing at the peak in 21-22. And I think 70% compared to the peak in 2017-18. So quite a bit below that. We also saw household employment, and I don't believe this number at all, but down almost 700,000, and the labor force down almost 700,000. That's flaky. I'm sure that's there's some mismeasurement there. And we had, besides the number of industries showing declines, we saw the participation rate dropping here. So that is also something the Fed pays a lot of attention to. When all is said and done, when you tally it all together, including the 0.4% average hourly earnings increase, income is fine, but it's just dispersed. It's been skewed, as we know, towards the higher income level, and that skewing probably is continuing as we move toward the end of what we're calling this rolling recession.
Even though the headlines, global slowdown, inflation chaos, dollar collapse, scream panic, the markets are subtly conveying a different message. Notwithstanding the speculation, there are no indications of a real breakdown as the US dollar remains close to the top of its long-term range. With the exception of gold, commodities are still muted. But even that move appears to be more of a hedge than a warning. Industrial metals are flat, which suggests a more subtle issue. A decline in global demand, especially from China. Rather than an inflationary overheating, a different type of warning is being flashed by the extremely low prices of Chinese exports, such as electric vehicles. Deflation. Equity markets, however, remain remarkably unaffected by all of this. The S&P is resilient in spite of trade tensions, geopolitical noise, and persistent rumors of a recession. Its performance against gold and oil conveys a sense of subdued strength rather than fear. Actually, declining oil prices are serving as a covert stimulus, lowering taxes for consumers everywhere. There is a strong, if not uniform, argument for further growth when you combine that with increases in productivity and innovation. Bond markets, which are frequently the most vulnerable to stress, are also not showing any signs of distress. Instead of plunging, yields are easing, which is a sign of normalization rather than a crisis. What about Bitcoin? Still trending strongly and outperforming gold, it is not only surviving but subtly leading. Such serenity may be the most obvious sign of strength in a world addicted to drama. What do you think? Is it hype, or is Bitcoin actually on track to reach $1 million? Please share this video if you found it useful, leave a comment, and remember to hit the like and subscribe buttons.